where we are talking about how the market is shaping up and how should you park your investments and navigate this market. And to give us more insights on that, we are now joined by Sushant Bhansali, who's the CEO of Ambit Asset Management, joining us. Hi, good afternoon, Sushant. Thank you so much for joining us today. Sushant, if you look at the market, if you look at Nifty itself, we have managed to fill in all the gaps. In fact, Nifty is up almost 10% in the last 1 month. Look at the macros that are playing out. Today we saw the oil, also the Brent crude, also falling below the $60 per barrel mark. The dollar index is still sub 100 levels, and the FIIs have also turned net buyers as far as Indian market is concerned. Do you see from here on this upmove in Indian markets is likely to sustain, because India has till now been underperforming its global peers?
We are in interesting time and very difficult to foresee how things will play out in the full year, because there is so much global uncertainty. Add to that domestic geopolitical situation, which might happen anytime as well. So there's too much of ups and downs. But if you look at and take a more long-term view of a year and 3 year plus, then you will see India as a great opportunity. If you look at the global economy, it's just not growing, and India, even after a small downgrade, is still about 6%. And from that perspective, there is growth markets, so I think will continue to rise. The equity flows within the domestic community of investors has been rising every passing year for the last many decades, and we are still underpenetrated as a country. From that perspective, if flows continue to come in, and we are now not necessarily only dependent on global flows to take our market to new highs. From that perspective, I think from a long-term perspective, India will continue to shine for investors, both domestic as well as global. We have seen a bit of global investors coming back into Indian markets. Probably the valuation correction which happened in February, in January, was a good entry point for the global investors. And despite what happened globally with tariffs, I think there was a big comeback for global investors in India.
All right, thank you, Mr. Bhansali. This is Kanishka also joining in. So India will continue to shine in the long term, is what you say. But are there any risks that you would like to highlight at this point in time, and also any pockets of the market that you think one should avoid at this point?
So definitely, I think if you look at dollar index and USD in particular, if you look at other currencies, has been depreciating, and that I think becomes a big uncertainty for exporters, which were anyway, I think, from a tariffs perspective, already living in a big uncertainty spot. And combine that with the rupee appreciation against dollar, I think it's giving on the funding side quite a bit of uncertainty for the next couple of quarters. So anything related to exports, especially dollar related, I think is something which one should stay away for the time being. At the same time, probably this uncertainty might provide some good entry points for long periods of time. So one should be open for opportunities in good quality companies, which have historically given good funding growth every year or every quarter. And those are the times you invested in those companies. From the domestic perspective, I think is the place to go currently. Rural has been recovering quite well. And that's why we are quite number on the domestic consumption, especially rural-related sectors, be it FMCG, be it BFSI, it is entirely domestic driven. Affordable housing, I think, is making a good comeback. So those are the sectors we prefer, and the sectors we are.
Right. Sushant, so you mentioned a couple of sectors there, but I want to ask you about Nifty Bank, because up until now banks have been providing a good cushion to the markets. They have been outperforming, but we see a bit of consolidation coming in there now, a bit of a correction coming in the banks. Going ahead in the next leg of rally, do you see banks take a back seat, or how do you see the banks do going ahead now?
If you look at Nifty and probably other large indices, banks will continue to be a large part of the growth for the fiscal year in which we are, and thereby not see banks losing the momentum in terms of valuation. Probably the upside is not that great as it has been for the past few months, but it was a slam dunk investment, I think, a year back when nobody was paying attention to them. And a large part of the juice is probably already inside the prices. But I think with the earning growth momentum, particularly most of the private sector banks coming in, I think there are many legs to go still in on that sector.
Right, right. Mr. Bhansali, I'll also like to shift focus to the oil space then. Now, oil has been trading below $60 per barrel. How much of it do you think could translate into positive earnings impact in this and the next quarter?
Definitely lowering crude prices help not just probably oil marketing companies or upstream companies, but also a lot of crude related sectors where the crude prices create a big price impact, be it on the chemical side, be it on the paint side. There are many sectors where crude derivatives prices make a big, I would say, impact on earnings. And in the down cycle, when the prices are going down, lag effect probably at least a quarter when till the prices are settled, and that's a good time to grow the earnings for those sectors.
Right. Sushant, also, look at how the broader market is moving. In fact, it has more or less, become, it's expensive again, because look at the way mid-cap is also performing today. It is outperforming the benchmark indices. Do you see that the valuations for SMIDs is still very expensive and one should refrain from looking at SMIDs, or how should one play the broader market theme?
I would say that forget mid or large caps, probably large caps, more money will come. So you can take a better view on that. But on the estimates also, there are pockets, I think, where there are still some valuation gaps on both sides. There are pockets or probably large set pockets where the valuations, if you look at on a TTM basis, are still quite expensive. And one should try to book profits if they are into those sectors and names. But there are many opportunities, I think, still where on the multiple basis itself, there are, especially on the domestic consumption side, these are the sectors where even on the SMID, there are, I think, lots of opportunities still available. So one has to take a balanced view and to keep into mind both short-term as well as long-term thesis of investments. And times like these throw opportunities for long-term investors to build a credible portfolio of good quality companies.
Right. So, Sushant, you mentioned a few pockets of value within SMID. There's still a valuation gap. So, what are these pockets of value? You mentioned domestic consumption, right? And what would be the other pockets?
Yeah, domestic consumption is one. Then probably chemicals is another one where there are. And probably I think very soon you'll find value in some bit of IT names as well. Right now, there's too much uncertainty, so there's too much pessimism. Also alongside how AI will impact. But the times, and we have seen over the last 2 and 3 decades that within IT sector also many changes happen, and IT companies that continue to come out with something new and different and continue to on their running growth path. So IT might throw some interesting opportunities time to come. I'm not saying that they are throwing opportunities right now, but in these uncertainties, probably in the next few months, you will get some good entry points there as well.
All right, then IT is something that you're focusing on. But so I would also like to take your view on the auto space. FADA came out with its retail data for April this morning, and retail volumes have gone up about 3% year on year. Both cars and two-wheelers saw about 2% of uptick in sales. So I would like to understand what's your take on this space, especially when three-wheeler sales have gone up about 24.5%.
So from our perspective, from investment universe perspective, I think two-wheelers are preferred compared to passenger vehicles, passenger cars or three-wheelers. There are more opportunities in two-wheelers. That sector peaked out in FY19. So it's almost been 6 years since we have not seen those volumes. And this year, probably last 2 years, things are picking up, and probably cycle might peak out in FY27 or 28. So there is a good runway still left on the two-wheeler side. Is what.
Right. So, Shant, let me circle back to where you mentioned IT. In the broader markets, a few IT names could throw up a surprise. But I want to understand your rationale behind picking IT, because is it because the valuations look attractive, because IT has seen significant drawdown? Because, the macro global headwinds still persist as far as IT is concerned, right?
Yeah, and that's precisely the reason behind getting into that. Not necessarily right now. I think there's still some more correction probably which will come because of uncertainty and also because of the results. Both Q4 results, some are out, but some are still pending. And Q1 doesn't seem to making any big difference on the earnings side. So there will be some slight of correction continue to happen. But these are uncertain times, and these is when the valuations will become, I think, the narrative will become negative on all the aspects, and thereby the valuations will look attractive if you take long term in mind. And time and again, IT industry has proven that they find ways and means to get back the revenue as well as earnings in times to come. There are challenges all the time. Right now, probably AI and tariffs. Tariffs are not necessarily from IT perspective, but AI definitely is a big challenge as to how much will it impact on the working. But we have seen in the past, whatever technology changes happen, the IT companies adapted to them and were able to come out. Probably there will be some shift in who are the winners, and there will be few losers as well. So one needs to be careful on that. But if you pick the right company who in your view will probably come out as a winner and able to find few such companies, I think there will be lots of money making opportunities in that sector in the next few months.
All right, then, Mr. Bhansali, before we let you go, just one last question. Some of the key risks that you mentioned earlier, how do you think one should navigate in this market? And, as your report also interestingly points out, skillful risk control is a mark of a superior investor. So how do you suggest on navigating this kind of a market?
Yeah, no, definitely. In our view, that risk is the only thing which differentiates between good investments and bad investments. The market will always make you money if you manage the risk well. And focus on earnings as well as other aspects of growth in corporates, you'll be always be able to navigate the cycles of market. And risks are not necessarily getting into, I would say, companies which don't grow earnings, or probably it's also about pricing. Do you price the risk or not as well? There are times when, because of your liquidity constraints, you have to be forced out of markets as well. And that's a big risk. And we saw many times, be it COVID, be it demonetization, be it GFC, and probably in the last couple of months as well, that these risks come to the fore in short periods of time, and one has to, I would say, manage those risks and create their portfolio accordingly. And if you are able to manage those risks and navigate them, then in long term you deliver, probably you can make much more money than benchmark indices.
Right. On that note, thank you so much for joining us. We will let you go on that note. Thank you so much for joining us. But we'll move.
If you like this video, then like, share and subscribe to ET Now.